Good evening, everybody. We have, again, the great pleasure of having Price with us tonight. I say great pleasure. He's been a good friend of mine ever since we did sessions together, and I can't even remember where they were with Price. Was it out in California?
I think California and Orlando, kind of back to back.
I think so. But anyways, look at his program. He has got a very interesting strategy and a very successful strategy for trading low-priced options. So without further ado, whatever that means, Price, welcome back. We're anxious to see your stuff tonight.
Oh, well, thank you, Steve, and good evening, everybody. Always a pleasure to be with you all. I'm going to share with you something I've been working on for quite a while. I've been trading for about 30 years now. I got started trading out when I graduated from Duke University. Thought this trading game looks pretty easy and made the classic beginner mistakes of believing my own analysis rather than listening to the market. We're going to talk about how to flip that around and get in tune with the market and how you can use low-priced options that really can give you a lot of bang for your buck. Now, before I get started, I just want to, of course, remind you that everything that I'm sharing with you here tonight is for your information and education only. Nothing we talk about here should be considered a specific recommendation of buy or sell any particular investment. And, of course, you know that you are 100% responsible for your own investment decisions. Big Trends and its staff are not responsible for any trades you choose to make, and not all Big Trends products and services are appropriate for all types of traders and investors. So this is definitely a higher risk strategy, so keep your risk level in mind. I'll talk about how to manage that risk along the way while seeking those bigger home run gains. Now, we don't provide any personalized financial, tax, or legal advice at Big Trends. What we do is we take our research and apply it to what we call our Grand Slam options trade alert strategy, and you get real-time alerts to your smartphone and your email, and then decide how you best want to utilize it. Do consult your tax advisor before you make any investment that might impact your unique tax situation. So what are we talking about here tonight? We're talking about buying options. Everybody's out there talking about spreads, iron condors, broken wing butterflies, and all these other complicated sounding strategies. We're about keeping it simple. The KISS principle has typically been my best trading approach, and basically it's about getting the trend right and then using what we're doing to take advantage of this by buying very cheap options. These are options that are priced at $1 or less per contract. Now that means you're going to pay $100 at maximum per contract to control 100 shares of stock. And the reason we said to start off, how to turn 400 into 1,100 on the way that we do our multi-tiered targets I'm going to share with you tonight is that we recommend that you get at least 4 contracts, which would be $400 a max. Sometimes, it might be, even half a buck or $0.75 of a buck. It might cost you $200 or $300 max in a given trade if you're starting for the bare minimum 4 contracts. We tend to, I'll show you in a minute what our results have been over the last year and a half roughly, but, bottom line is that we tend to see a lot of people that start with, say, $10,000 in a model portfolio, and then we would say, then never commit more than 10% of the trading capital you use for this program into any new trade. It's a pretty good guideline for whatever your trading strategy is. You don't get too high or too low off any winner or loser. Just stick with it over time. We're going to talk about gamma as a theme that can give you a lot of bang for your buck. And we're going to share with you my Grand Slam options filters, the CCI, the Big Trends bands, and the ADX. Now, it's baseball season. I know Steve's a big Pittsburgh Pirates fan. I keep up with the Cincinnati Reds. They're not far away from my hometown of Lexington, Kentucky. Bottom line is that, in baseball, if you're new to the thought of what's a grand slam, the idea is that if the bases are loaded, you got somebody on first, second, and third base here, and somebody hits a home run out of the park, that scores a quick 4 runs as a grand slam type of a home run. And, so we're not really trying to focus here on getting on first base, per se, getting the singles approach. Here what we're looking for is at least a double on our money as we get to second base. We'll call it plus 100%. So that's going to be our first target. I'm going to recommend that you take out half of your risk capital when you can get a plus 100% gain, because if you take half your money off the table with a double, the rest of your trade is free. You've already gotten your risk capital back in your pocket. Now, when the good ones keep on rolling and they go to the next target at a triple, that's 200% on your investment. Now you're at third base here and you say, okay, can we get all the way to home? Well, if we get a 4-bagger, that's actually a 300% final target. When we get 4 times our initial investment. We get plus 300%. We're saying that's enough. We're not greedy. That sounds like we're being greedy, even looking for that much. Some of these will go on to be even bigger, but we have had the experience where a lot of these will get to about that 300% level and then kind of peter out. So the reality is we need to be focused on, okay, where are sensible places to gradually take money out as the market makes it available to us. So that's kind of first leg of our aggressive option strategy here, is that as the market's making money available to you, you take some of your chips off, some more of your chips off at another target, and the rest of your chips off at the final 300% target. When you do the math, that $400 could turn into over, in this case, almost a triple because of the pieces. We saw half and then a quarter and then a quarter. It works out to be like $1,150. So we're saying how to turn 400 into 1,100 plus in gross profits. Now the results for us through today's close, which happens to be the end of May, so it's kind of a nice end of month finish here to recap as well, is that over 17 months from the beginning of 2017, this portfolio, if we just took $1,000 maximum in any trade, which would be never more than on a dollar per contract, that'd be 10 contracts total you'd buy. If we had a $half contract, that'd be 20 contracts you'd buy if it was $1,000 max before commissions. We'd be up 28,000 plus in gross profits, adding up all the winners and the losers. And every once in a while, there's even going to be a crap out in there where something just doesn't fire as quickly as we thought. We give them a little bit of room to get started. Something really goes dramatically against us. We might be out our initial investment every once in a while. I say that because I want you to realize that this is not a strategy for widows and orphans. This is aggressive growth. But there's a lot of reasons why I think it's a great time to add this growth kicker into your portfolio with options being relatively cheaply priced. So I'll tell you more about that in a minute. But the bottom line is you add that up over 17 months, 28 grand. What does that work out to? It's about $1,650 a month. Again, gross before commissions. We're not doing that many trades in a month. I think we did 5 in May. We might do sometimes up to 10 in a month, but an average of probably 6 to 8 per month, is a pretty good norm. So you're not, and we're just buying options. So we're just buying a call or buying a put, and we're just focusing on how to get that growth phase of a trend. I'm going to start showing you some charts here and start to warm you up to exactly what we're looking for. But before I do, you get some flavor about, the success we had last year, of course, first 8 months of the year, not a losing month. And then all of a sudden, September, we kind of get whacked a little bit. Thankfully, we made it all back in October and then some. Same thing, November, small loss into, at the time, December of 2017 was our biggest gain, $4,900 in gross profits for just a month. We're talking about just $1,000 a trade. How is that possible? Because we were hitting multiple of these 300% ultimate targets in addition to taking doubles and triples as the market made it available to us. Then January this year, as you know, a lot of people did well in January. And I see I've got Chris Sarah in here, my lead consultant, so he'll help answer questions through the chat box as well. Thanks for popping in, Chris. Bottom line is that you say, okay, January monster gain. Then, most people get back their gains when the market plunged in February. I was extremely pleased that we made money in February, too. Now, yes, we gave some back in March, and we had basically a flat month in April, down $15, but then we just finished May up another $921. The S&P was up, marginally. But, again, on a model portfolio of $10,000, you're talking about adding yet another 9% to your portfolio. So the thought is, that's the kind of growth that can really give you the kind of kicker in your overall portfolio strategy that will dramatically improve your results. Now, it comes with risk, so that's what I want to talk about is how to manage that tonight. Now, when I was getting the word out about Grand Slam to my Big Trends community, last year, throughout the year, but in particular as things were really heating up in the fall, what really got me excited is that this strategy also gives you a way to even trade earnings once you have a free trade, once you have a ability to just let it ride into the earnings report if the trade's working. If it's not working, I never recommend holding into an earnings report and hoping. A lot of people get into that hope mode, and that's not a good place to be for your portfolio. You've got to have a very systematic approach. We're going to talk about what all these things mean here, but essentially we're going to talk about the percent R, the second panel. We're going to talk about at the same time the CCI was setting up here. And then a little bit later, the ADX was setting up, and all three of those were confirming as of once we got through this resistance here, right about this bar is close. So we're buying the next bar's open right here. on the Microsoft at the time, November 80 calls, when the stock was actually trading at about 76.5. So you say, hold on, you're buying an out-of-the-money 80-strike call. That's a right to buy Microsoft at $80. Why would you buy that when it's down at 76.5? Well, because the thought here is that the out-of-the-money options, yes, they're all time risk. These options are definitely a little more speculative, but when you get a big trend like this, you see it's about a week before the earnings report, it ran up to about 78.5, up about $2. We're able to double that option. And we initially got into this one actually for just $55 a contract, and then got $1.10, got a double, didn't get the triple right before the earnings, and I said let's go ahead and give it a go into the earnings. The trend is still positive here. We're going to walk you through what all these things mean with the ADX in green on the bottom panel headed up. You want to see that green line going up, up, up. You don't want to see that coming down. ADX is a sign of a trend. We'll get into each of these pieces. But basically, I've got my big trends bands, which is kind of another way to visualize the overbought mode when something like Microsoft goes overbought and stays above that upper band. That tells you it's in a strong uptrend. When it gapped up right after the earnings, it was at $84.30. When we sold those 80 calls for $4.71 against a 0.55 entry, that meant it was a 756% gain after 11 trading days. We'll get into that a little more and show you the options chart on the Microsoft big win there as well. But so occasionally you get the windfall even bigger than 300% when it gaps. Any gap to 300% or more, I take it and I run. Okay. Now, why is this still a great opportunity? Through the end of last year, we basically had the volatility index. I know you've heard of it. The VIX measures how much volatility the markets are priced for. Well, we've been hovering for most of the last year plus in the mid to even low teens. I think VIX late last year, touched down below 10 even. It might have spiked to as low as just a tick under 8, which means that the market's going to be plus or minus 8% over the next year. We know the markets tend to be a little more volatile than that, and it just shows you when people are not expecting that much of a big move, everybody's kind of like, hey, it's like watching paint dry. You can actually buy really cheap options because what this VIX impacts is it impacts the pricing of typically, especially the at-the-money and out-of-the-money options that are all based on time and volatility. When you buy low volatility and you get big trends, that's the perfect combination for one of these ultimately $400 into $1,100 kind of opportunities. And we want to do that as many times as possible. And of course, the more you're trading, you could turn $4,000 into $11,000. If you think, well, who cares about $700? Well, I do because it's all scalable here. You can actually, and we're doing this on very active stock and stock options, so you don't have to worry about moving in. We're moving thousands of contracts in and out without any problem with this approach. Now, VIX, as you know, in February this year, it spiked to 50. Kind of one of these moves like I had in the flash crash here of 2015 where it spiked up just over 50, but it was right back down about a month later on that one, down below 20. We're back down into the mid-teens yet again on VIX. Spiked up here last week as we got a little sell-off late in the week, but it settled back down. So we're hanging in the mid-teens. What that means is that if you're buying options expecting 15% volatility and the stock or market gives you 100% potential upside on an annualized basis, if it moves, say, 10% in a month, that'd be 120% annualized. Do you think you can find a stock that moves 10% in a month? I'm going to show you exactly how to do that, or even with a lot less of a move and still get your targets. So anyway, we'll get into that. But when I talk about grand slams, and I think about the baseball analogy, no person personifies the home run mentality better than Babe Ruth. He was the home run leader of his era, and all the way through until I think 74. It was the mid-70s. I remember watching Hank Aaron hit his 715th live with my dad. Bottom line is, though, Babe's record lasted for a long time. But what fascinated me when you go and look him up is that for 714 career home runs, you've got 1,330 career strikeouts. And as the Babe said, he said, never let the fear of striking out get in your way. Now, we don't want to strike out with this aggressive home run approach we call Grand Slam options, but we want to focus on that, occasionally there's going to be trades that don't work. And the reality is that you can still make a lot of money buying options when you can make multiples over what your risk is, because you can't lose more than you put into a trade when you buy an option. So that's a worst-case scenario. The best-case scenario is often many multiples bigger than that, like the Microsoft example, some 7 to 8 times bigger than what the risk was. Now, of course, Babe won 7 World Series total, but 6 where he actually played, so I didn't count that one that he didn't play when he was first with the Red Sox that year. But bottom line is that he's a World Series champ 6 times plus over, and the idea is he swung big with everything he's got. So the thought is you have to have fear take a back seat when you use this strategy, because I know a lot of you, and I've talked to so many folks ever since the Great Recession in 2008, a decade ago, so many folks have been so bound up with fear, so bound up with their past memories of losses that's really cost them a lot of opportunity. And some people have gotten a little more comfortable with risk as we've seen the bull market progress over the last decade. And the reality is it's not going to last forever. At the same time, while it's lasting, we're going to take advantage of it. And when it changes, we expect to take advantage of it on the downside too, because we have success with this method with puts as well as with calls. So we're going to walk you through that, and also how we can avoid strikeouts. Now, this menacing gorilla here, I call it the 800-pound gorilla, you have to be aware of, right? You don't want to fight that thing coming at you. You want to basically make sure he's going the other direction, and you follow along for where the action is. The institutions, in my analogy here, are the 800-pound gorilla in the room. They're the ones that are really dominating the market trends when they're moving billions upon billions around. And so that is very, very important. Now, the number one fundamental catalyst I want to talk about that I do pay attention to is you have to watch earnings and earnings reactions after the news. If you get a great-looking earnings report, big blowout on the numbers, and the stock goes down on the news, that is not a positive surprise. The thought here is that we want to see something that's saying, you know what, the institutions are basically underinvested in this name, and they're going to continue to push into the stock and keep pushing it higher. And so that tells you that there's a lot more buying to come. We'll show you how the technical indicators that I use show that very, very clearly when we get the right follow-through. So go with the earnings surprises. Never fight that 800-pound gorilla. Never stand in front of that. Never bet that, well, the earnings look good even though the stock was down, I'm going to buy some calls. No, that's a loser's mentality. We want to get you on the winning side of the equation. Another key opportunity here is what I call the fat tails of the distribution. What this means is that the chart on the left shows a normal distribution. It says that basically if options actually move like a normal distribution, it says that 0 deviations from the current price, meaning that we stay at the current price, is 0. Should happen about 40%, it says that we stay at the current price. In reality, it's a lot closer to this chart on the right. It's a log normal distribution where there maybe 30 to 33% are staying flat like that. So yes, we want to avoid those situations, but they're actually making bigger moves than what people expect. These tails, as you can see, greater than 2 deviations, are happening about 5% of the time on each side, whereas on the left, you can see that the log normal distribution says they're happening about half that much, about 2.5%. So these tails are about twice as wide as what should be expected. And so the reality of that is that when you get on a big trend, the big moves can last longer than you expect and go much bigger and have much more dramatic staying power and potential for you to make money. And of course, a 3 deviation down move should only happen like 3.5% of the time. I'm sorry, it should only happen, with a 3.5% drop on a 3 deviation down move. This should happen a lot less than 1% of the time, like the 100-year flood. But actually, it's happened like 100 times in the last 90 years. So it shouldn't be happening hardly at all, and yet it's happening with a lot more frequencies. Now, we're going to talk indicators, get you into some of the charts here, and you got to understand what we're looking at. So one of the key tools I like to use is the Commodity Channel Index. This was developed by Donald Lambert to trade futures back in the start of the 80s, and futures and commodities, but I've shown it to work with a lot of other big-name stocks, especially the growth-oriented stocks that have really been the leaders on the upside, and when the market tanks, they're the leaders on the downside too. What CCI does differently than most is it actually takes what's called a typical price, which averages the high plus the low plus the close. Most other indicators take, like a moving average or other technical tools, will just take the close over a certain number of past look-back bars and then say, okay, we're looking at whatever it is, the last 200 days closes a 200-day moving average. Well, this cares about what happens with the high and the low each day as well. So it's trying to gauge where the close is relative to that high and low to give you more of a typical price where the momentum is positive if the close was near the high, momentum is negative if the close is below it, but then it's looking at each bar and then adding those up over a series of total bars. Now, what we want to do is say that overbought is an opportunity to actually trade these to the upside. That's going to be one of the big takeaways I want you to walk out of here with tonight, is to realize that overbought markets is not a bad thing. Overbought stocks can get much more overbought, and your job is to quit missing out on these big trends. I'll get into that with another concept in a minute, but another tool we need to know is that the trend is definitely your friend, and it's especially critical when you're buying options to get good, solid, and preferably powerful trends. So ADX is developed by Wallace Wilder. This is the average of the various directional movement positive, which means basically net new highs, and directional movement negative, which means new lows over a given look-back period. And then it forms a percentage to take the total point movement divided by what's called the true range over that period to give you, okay, how much trend are you getting relative to the total movement in the stock. But essentially what we want to see is the ADX should be rising to tell you that the market is trending. We'll get into that next. And then the third leg of the stool is the Larry Williams %R indicator, and I use a tweak on that to actually call it the big trends bands. The normal %R indicator would show you that in red it got overbought here on the bottom panel. And what we did is we converted that and said, hey, what if we put a band around it to say if we get in the top 20% of readings, it's moving outside of that upper band where it should be staying put. As you can see here, this is Baidu, and Baidu is one we actually scored on as well here this past month, earlier in May, for 100, 200, and 300% gain. This was a prior example from the middle of last year. But you can see how fast these things can heat up. We're getting our first signal when it gets through that big trends band, and then the stock doesn't stop there. It's not an overbought trading range, top of the range anymore once we see the stock closing through that resistance. And so when you start to see that breakout, you can see we're getting on board, and immediately it's starting to launch. And over a period of next day, 3 days after, 4 days after, we've got our 100, 200, and 300% profit in 4 trading days. Now, you can say in this example, we left some money on the table. It kept going, and that's indeed true. But the reality is that we found that there's enough of these that turn and flip that by the time you give up that 300, it turns it back into plus 100, or worse yet, you give it all back. Those are the kind of situations where we're willing to leave a little bit on the table for everybody else if we're getting our 100, 200, and 300% profits. As the old Wall Street saying goes, bulls and bears can get rich, but hogs get slaughtered. So let's not be piggish about this. Let's go ahead and focus on this. The idea that, again, I want you to realize is that it's like the Pareto's principle, that the top 20% of the %R readings is where you have the best results in a trend trading approach. That overbought can stay overbought a lot longer than people expect. Same thing on the downside. If it goes below that lower band, it keeps going down. This one did not. So as you look at all the pieces of the puzzle in that Baidu example, you can see there's our %R going overbought on the traditional %R reading right here. It closed above there the next bar. Why didn't we buy there? Because we're waiting for the other pieces to come on and notice. In this case, the yellow CCI took a couple more bars to go ahead and confirm right through that resistance right there. So that took a little longer. ADX in this case, we look for that green average directional movement line to start turning up above the declining directional movement. In this case was the negative directional movement in red, the positive directional movements in blue. So obviously you have an uptrend with the blue above the red, positive above the negative, and then the ADX starts to turn. So ADX actually started to turn before these other indicators. That's a little unusual. Usually it might be in sync with or even slightly behind the %R and sometimes the CCI. What you care about is that it goes overbought and then it stays overbought. So remember, what does % range means? It means where's the stock closing within its look-back period range. Now, when you think about it, if we say we're looking back over the last 10 days, which is, we use a different setting than that, but if you look over the last 10 days, say the stock had been trading between 100 and 110, and say it closes at 110, you say, well, it's at 100%. It's at the top of its range. Why would you buy right at the top of its range? Because it's not a range if it keeps on making higher and higher highs. It's a new trend. And so that range keeps getting stretched, and yet this thing still stays in the top 20%. You see, only as it starts to come back under here does it get questionable as to what's going to happen next. So, but you can see also the ADX lasted until about here before it turned down. So again, we could have used some of these other tools. CCI actually never violated them until just after the right side of this chart. So the thing is that when you're buying out of the money options, you need to cash them in quickly as the move is hitting your targets, because if it slows down on you, you can see some give back as those things are moving. If they're still out of the money, as they basically are, or if it's moving against you with both time moving against you as well as price action moving against you. I mentioned I want to talk about gamma because everybody talks about theta, which is the time value decay. Some people talk about vega, which is how much volatility changes will impact you. That's more important right around earnings season. A delta is how fast your option is going to move for a point move in the stock, and these are fairly low delta options when I buy them initially. We're really looking for something where we can find something that's going to go from a delta that's around maybe 30 or 35%, and then the rate of change of delta is going to accelerate. So it goes from out of the money to at the money. That gamma effect will be at its highest, meaning that every point move is picking up the most delta possible. If it says it's a gamma of 9%, it means that if we're right now at a delta of 50 at the money, the next point move should be a 59 delta a point later. So you keep picking up deltas means you keep picking up more and more bang for your buck as that trend goes from out of the money to at the money to in the money. So that gamma effect is particularly pronounced when you're right near the strike price, or in the case of options that we buy about a month out or so, even like a little bit out of the money has the highest gamma. Here's a case where Randgold Resources were a 300% profit really served us well to not give back the pullback that happened after that. So we were buying the 110 calls, which were almost 10% out of the money when we got our buy signal. By the way, we need all three legs of the stool to be coming on board. You can see that looks like there was a period there where the percent the big trend bands there on the upper panel were starting to go in your favor. You can see that CCI was the one that kind of held us back from the prior confirmation. We didn't quite clear that resistance. But you know what? When CCI and then ADX all came on board right here as of late August last year, we're saying, look, stock's ready to launch. So we want to get on board that 110 call. And in 2 days, it had gapped up even beyond our 100% target, and it opened at 160%. When that happens, I say, thank you very much, Mr. Market. We're going to take that 160% on half our position. And now we've not only guaranteed a free trade, we've guaranteed we're making money no matter what, even if the rest of the position tanked against us. So in this case, you see it kind of pulls back a little bit, then it keeps going. Notice how the big trends bands are holding so nicely through that rally phase, you know, as they start to lose it. And then, of course, you're seeing that you're having some give back in both price action and time loss as well. And again, this one got up near the strike price. It didn't even have to go in the money, and we were getting the 300% profit, as you notice, on the last square there right at the top. And we didn't know that was going to be the top. We just said, look, we've learned by enough samples that 100, 200, and 300% are good numbers to go ahead and say, let's book profits steadily and gradually and then be done at 300%. If it goes to 500% or 1,000%, some of them will. I'm okay with that because some of them will go from 300% back down. So we're trying to say there's a sweet spot. Your job is to take money gradually and steadily as you hit each of those profit targets. Now, speaking of sweet spots, there's a sweet spot on time erosion and time decay too. And so, okay, how much theta, you know, is acceptable? You know, because most people would say, well, if you look out 4 months before expiration, 120 days is 4 months before expiration. 0 days would be the expiry, the expiration day. You say if you go those first 30 days from 120 to 90, you can see that the time loss is just a sliver. Now, maybe you lost, 5 or 6% of the total options value over that 30 days. You say versus the last 30 days before expiration, you're losing like 2/3 of the option's total value. And if we're just talking about at the money or out of the money option, total time value is what we're thinking about. Now, you say, why would you ever buy an option with 30 days to go before expiration? Usually I'm buying them a little further out than that, somewhere around 45 days. And what I do is I say, okay, but up to, even about 5 or 6 weeks before expiration can be acceptable. But what I do is I say, if you count down from, say, 45 days to 40 days, and the stock has not moved in your favor, I'm going to get out after 5 days and only take that much time decay over those 5 days. So essentially I'm saying, look, let's have a tight window where if I'm not getting enough trend move to overcome the loss of time, I'm done. I'm out. Moving on. But if I am getting the trend move, I want to keep riding, and your leverage is going to be a lot greater with these options about 6 weeks ago before expiration because you're paying a lot less total premium. So now you have the ability to create very quick and dramatic leverage in very short order. A quick gamma chart as well to see, like on the expiration day, we'll put that in red. We would never trade them for just a one-day hold on expiration morning, but that's what this assumes. You bought a 50 call, stock's at 50, it's at the money. An at-the-money option uses a 50 delta to start, and it's saying you would actually have about another 43 deltas to pick up on a one-point move with the 43 gamma peak there, saying that, okay, if it goes from 50 to 51 on the last day of the option's life, it's saying that next move from 51 to 52 should be basically 93%. The initial 50% plus the 43 gammas means essentially that second point move from 51 to 52 would get you 93% of that point into your option premium. So you can see that works both ways. It can also cut against you if you're really wrong. You go to 49 on the expiration day, you were 50, and you've got to get back over 50. It's saying you've got about a 7% chance of that happening as your 50 delta drops 43 delta points on the next point down at 49. It says now you've got a delta of 7 on the last day of expiration. Notice on the purple line with 60 days to go, you can see that we've got the slightly out of the money option where the stock's trading around 49. You buy a 50 call out of the money by a point. That's giving you your maximum gamma effect. The gamma really can be dramatic for us. I mentioned Microsoft earlier. I took that half profit. I put myself on the real time at the time, saying, we start holding the rest into earnings. And I showed you what happened there. I'm going to look at the option chart in a little bit too. Some of the stocks that I like to trade, I use less than 50 total names with this methodology. So we're talking about some of the most active and growth-oriented names out there. As I mentioned, we just scored the 100, 200, 300% on Baidu this past month. And then also from the perspective of, we also scored a double on MasterCard in the first half of our position this past month. Then the second half ended up, stopping us out back around where we got in, so we made about 50% on that trade overall. So sometimes they don't follow through past the double. If that happens, we get out at a break even, thereabouts, and we move on. But again, if you get a double and half, a break even on the other half, you're at plus 50, right? So that's not a bad position to be in. But you see a lot of tech names: Microsoft, Alibaba, Broadcom, AVGO, NVIDIA, of course, popular one, and then of course Tesla kind of fits into both technology and automotive, but with the tech theme. Wynn Resorts and Vegas Sands within the casinos. You can see also, some of the oil and gold names like Schlumberger got us 100, 200, 300% back in January. Randgold, I showed you an example of that earlier. So these are names that can definitely get going in a hurry. And like I mentioned, the credit card issuers, MasterCard, Visa, and others, we really like. Now here's a couple of Tesla examples. One of them that did not work out, followed by one that did work out at its full potential. This first one on the left, what you see is I draw a line up all three of those. You see where we're getting a buy. We're trying to buy it the next morning after that buy at the close, and then it's gapping up here. And so we're actually not able to get in because it gapped too far too fast. If we could have gotten filled there, it obviously would have been a good trade. We instead said, in this case, you know what, we'll buy the first retest in %R, which is right off of this low, back in mid-April last year. But the thought would be, that should get going quickly. You see it does rally, but it doesn't rally enough. Now here's where another of our risk management rules comes in. The first week of May, in this case I think it was Cinco de Mayo on that Friday last year, May 5th. Well, the end of the first week of May, these are May monthly options. We're never going to hold an option with 2 weeks or less to go in its options life. So as of the first Friday of the month, right before the third Friday, 2 weeks before the third Friday's expiration, whether the trade is a big win, a big loss, or somewhere in between, we're going to say we're not holding anymore. We're not going to take that theta risk of the last 2 weeks. It's just not worth it to us. We can move on to greener pastures with more time on our side and not have to fight that increasingly melting ice cube of time. So that trade ended up being a wipeout. I mention it because if you gave up after a wipeout trade, you see you missed a big all targets achieved on the next one. All three of these in late May were signaling, and then it closed above there right at the end of the next day. Because you got that launch through this next about 7 days here, you're able to get 100, then 200, then 300%. And you can see, if you wait for the violation here when we're getting our exit, you've lost time and you've lost price action, and you're now on the, you're trying to get out of the crowded theater when somebody yells get out, and bottom line is that's not where you want to be. You want to already be out in safety of cash and looking for the next opportunity away from the madding crowd, okay? So you see also it looks like there's a buy signal over here on the middle part of the chart, but that's just because %R was setting up, but the other indicators were not. CCI was not confirmed. ADX was not confirmed. So we'll get like that alert to be like, hey, we want to pay attention to this. But when that ADX is going down, you say, no, thank you, not interested, not a classic trend type of a trade. Same thing on the downside. You know, you look at a Schlumberger, you know, it's one of the biggest, if not the biggest, oil services stock, and you see Schlumberger was breaking down on the %R first on this big gap down that happened right after. CCI is right there with it as well, and then ADX took a little more time to get going, and that's where we're getting all three confirmed. There's our downward signal. Now you see the stock's trading maybe like 72, 73, and I think we were recommending a 69 strike put, and you see it came down quickly to the strike and slightly in the money. Got 100 and 200% profits off of that quick 5 or 6 day drop, and then when it popped back up with a week to go here, that first Friday in May, we're saying, okay, you know what, we've got to say bye-bye to the trade. I think it was like 67% on the remainder of the trade. So, you know, the thought is, okay, you know, you're trying to take advantage of that free fall mentality, but you're trying to also, if it doesn't move, trying to get rid of it typically after about a week or so of being held. Here's another one we did not take, where you can see the CCI never got there off of that whole move. Tried to get there right into the resistance, but never got through there in mid-September to late September, early October. Just kept us out of trouble there. We don't just look at stocks charts. We also like to look at what we call option charts. Why would you care about an option chart? What's different about it? As you know, an option chart, especially when it's an at-the-money or out-of-the-money option, is priced totally on time value as a function of its volatility, time to expiration, and the other key inputs where the stock's at, you know, how much of a chance it's got to get from out of the money to in the money, etc. So we like to look at the option chart to give us another visual about, are we getting the bang for our buy this option? If we're seeing a stock breakout, the option had better be breaking out right with it or soon behind it. It shouldn't be taking very long at all. If the option chart is not breaking out, I don't want any part of the situation because it's going to be too slow. You need speed of movement when you're trading options, especially when you're buying them. So this is geared at finding those big speed trends when we get them, and then saying, okay, let's wait until we get our next one here so we can keep it really simple, keep you really focused on the next opportunity. So time decay is always on our mind. If you look here at we're going to look at, during this breakout phase here, you can see everything was lining up real nicely here. We're getting that signal off the close. We're getting the next bars open here. And you see it's kind of grinds a little higher that first day, then chops around for a couple of days, then rallies on the fourth day. And we're saying thanks very much. We get 100% on the first half position right into that resistance, followed by the retracement. And we said, okay, now we're back at break even a few days after that on the second piece. That's enough to say get rid of it. And up 100 plus a break even means you're up 50% on the trade. It turned out that they reported disappointing earnings, and the stock took a big sell-off here last October. As you know, Goldman's been getting whacked here recently as well. Let's have a lot of the financials. So it's something we're watching. Now, if you look at the option chart on the left, where we're getting a Goldman Sachs November 260 calls for $1, there's $1 on this chart. So you can see we're getting in right here as it's at $1, and then we're just riding that trend. Notice we get kind of a violent little intraday %R retest right here, still positive. Then we go on up very dramatically all the way up to a high near 240 before it came crashing back down on that option. So, you know, this is the kind of stuff that, you know, when you look at it, say, hey, I'd like to be a part of it when the wind's in my back, when it's easy, but when it gets harder, you know, when you're trying to buy dips and stuff, it's oftentimes going to take a lot longer than you expect. So we tend to encourage folks to really zero in on that. Now, I showed you this chart earlier about the 756%, but let's actually look at the option chart here. So the option chart was was a November 80 call. We were recommending it at 55 cents right back here October 12th last year. You can see in this case that it just he kind of just chops around there on that 80 strike call, and then starts to heat up here and gets to like $1.10. We're saying, you know what, we've got to take our double on half. Earnings are only a week away. We get all our risk capital back in our pocket. What if I'm wrong? What if it actually gaps against us and that second half of the position is a crap out? If you made 100 in the first half, you lose 100 in the second, you'd be at a break even minus any commissions. You know, so the thought here is that this is the kind of situation where you say, look, this thing was really starting to heat up. Everything looks good to go. And so very pleased with the outcome as that gap really is what's needed to, you know, occasionally have these big windfall profits, even as you, in a very disciplined way, follow your other stops and make sure you don't get caught holding the bag. Here's Broadcom, ticker symbol AVGO. You know, they were in all that rumored takeover with Qualcomm there for quite a while, and stock was heating up right into that news. And here's a case where, you know, when we recommended that 320 call, we got in like right off of the open here on that stock, and then basically it dropped about, I'd say, what, maybe 10 to 15 points by the next morning. Then it reverses, closes back right around that same level, 260-ish, and then takes off. And you can see that, you know, now we're sitting pretty, and then bottom line is that we're then seeing it tank back off, and we just said, okay, the rest of the trail of break even was taken out after having gotten a double in the first half position. Now, you can say, well, gee, what if I took 3/4 of the trade off at a double? You could do that as well, but we just find we like to keep it balanced here. Now, you know, on the downside, T-Mobile was one that we caught before. You know, they recently had this news of the takeover with Sprint, but back here last November, there was rumors about a Sprint deal on a Friday, and I was like, that's just a bear retest. Everything here is showing us downside potential on the %R, downside potential with the CCI being so weak, and saying, look, there's an opportunity here to take advantage of, you know, getting in right into the resistance and then getting out the next morning at that doubler. So, you know, we got that double and then put a target on the rest of the position as it was starting to flip a little bit, and said, okay, that's enough for us. Southwest Air, you know, they've had their problems this year, but last year in December was very, very good to us. We rode this one for quite a while. We got 100% in 5 days. We got 200% in 11 days, and I think it took an official about 2 more days, about 13 days in, to get our 300% profit as well. You see on this example, I've got Southwest climbing and then closing above its prior high. So this close higher is the bull confirmation. CCI was doing that too. ADX is just starting to trend. All those things look good. You know, so this is the kind of stuff you say, okay, that's what we're looking to take advantage of. Is this kind of a situation here where, you know, you get a nice steady trend. You see, sometimes you get what we call a retest. We'll come back in and test that 80 percentile level on the %R, or this big trend span, as I call it, in light blue. And our goal is to say, look, we need to really ride this thing and keep stretching it as long as that trend is still in motion and keep on trending with it. You can see this is talking about Best Buy 67.5 calls that we bought back in December, catching them, getting into the 67.5 calls for 80 cents a contract. It's $80 to control 100 shares when the stock's trading just over 62. So we're buying an option that's like $5 or about almost, what, 7 to 8% out of the money, 7% out of the money. And we got that 100%, we got the 200%, and then the final piece didn't quite get there, and then came and flipped on us and took us out at 118% on the third piece. Took 20 days on that one. So we're dealing with a daily chart with plenty of time, in this case, to let it ride. Mylan Labs, another one that you said, gee, that's not a household name, not a big name, but the beautiful thing about it was I felt like I would kind of miss this breakout, and then it followed through. And I was saying, okay, look, here's the first retest that I've seen on this. And so I was saying, yeah, this is an opportunity to buy the dip on this and then see if we can keep on trading it gradually upside. And you see Mylan hit its targets very close to the final exit date, which was right around I think January, I want to say January the 5th or 6th. And you see it just rocking and rolling right into the end of the week and saying, yeah, at that point, you're going to see that it's something that's catching more and more people's attention. And the heat is on, so to speak. And so that's something that you really want to take advantage of. Now, the basic foundation of this whole approach is using this very aggressive but focused option strategy called the Gamma Booster with option charts to kind of validate what I'm seeing in my big trends bands, in my CCI, in my ADX. I'll look at the option chart too and just basically get that extra set of eyes to make sure that it really makes sense as to the right kind of an approach. Now, we look at these stocks as being pretty much tailor-made to this strategy. Most of them are growth-oriented stocks. They've had a great run here lately. And so the question is, okay, the more I can focus on the best of the best and not try to follow thousands upon thousands of optional stocks, the more I focus on the best of the best, the better I'm going to perform, because I'm not going to have stuff slipping through the cracks. I'm not going to miss signals. I'm going to say, look, I know exactly what I'm looking for. Let's go ahead and see how to find it. So, yeah, you go to bigtrends.com/GSO. I'll get into that here in just a minute when we walk you through the offer just a little bit. But I want to show you another example here. This was a couple more. This was Cummins Engine. And I was a little concerned when I did this trade because I thought, well, gee, there's this overhead resistance up here around 180. And we're buying a 182.5 call. We paid $70 a contract. So, again, $70 to control 100 shares of stock. The stock's trading at the time around 176. So we got our double about on the 5th day after. We said thanks very much, and then as it went up a little bit more, we hit our trailing stop up 57% on the second part of the position on that 6th day. We said, okay, now we know what we need to do as far as where to unload this position. It makes it a lot easier. Now, Schlumberger was one I talked about on CNBC World back in September after the hurricanes, and I said oil last year in the fall. I said oil is my favorite value sector. If you've watched the oil stocks, you know what a leadership sector they've become. The beauty of this was that every time, it looked like we were getting the breakout, and then we got the confirmation the very start of the new year, January the 3rd, a bull confirmation, so we're in there buying that next morning on that tiny little dip that got us into the 72.5 calls for $1. And we got the 100, the 200, and then we actually did get, it got 280% within 4 days, but just a day or two after that, it got the full 300%. So it's one of those where you see the launch effect, and just look at how powerful that launch phase is as we break out all that prior resistance, and we start to see the sellers be relieved that in this case it finally stopped, but not until it went up to the maybe 78 area. So there's several keys to be a Grand Slam options trader. The bottom line for me is that you have to be clear about your catalyst. For me, when I'm looking at stocks, I always make note of how the earnings reaction was for all the big stocks. Was it neutral, positive, or negative? And try to give it a grade so I don't get too hung up on just one thing that I happen to be seeing, but rather that you get multiple things, multiple rivers flowing in your direction. Makes your life a lot easier. I buy out of the money options $1 or less. Right now I'm buying July, so June's too close with its first Friday being where I would close things down tomorrow. So we wouldn't buy June. Haven't been buying June for a little bit. But July is where I'm looking at now and trying to give it a chance for at least a week, and then if it's working, give it more time, let it keep working. And then remember, when you are in something that's not working after 5 trading days, you can say that's what we call a time stop. That's just giving you the clue to say, you know what, it's not the winning profile anymore. 5 days later, it hasn't moved, or you're down a little bit. That's not what winners look like. Winners, when you hop on, they just keep going fairly quickly. So as we get those moves in our favor, we wanted to book those windfall gains. When we get a double, we take half off of the double. When we get a 200% gain, triple our initial investment, we take another quarter of the original position, half of the remaining half, and then we take the final 300% on if we get a continuation move or a gap. Say thanks very much for allowing us to book all those profits. So and we do recommend, like I said at the beginning, don't overcommit your capital, especially when you're doing something more aggressive, and especially as you're getting your feet wet. We want to make sure that you're really zeroed in on just kind of looking at this as like a a longer-term plan to build wealth rather than expecting a get-rich-quick type of a mentality. And then you get weekly video training from me. It's not a black box. I share with you all the settings as a subscriber when you go to that bigtrends.com/GSO special page we set up for you. I'll actually cover that page in a couple minutes as well. If you came in late over 17 months, up 28 grand, assuming never putting in more than $1,000 a trade. See, it's been a pretty impressive phase. Some people say, oh, it looks like it topped out. It's been kind of choppy the last few months, and saying, you know what, it's still doing quite nicely, and it's already up huge for the year because of the big January gains and the continuation gains we had in February, not to mention the gains we just had this past month in May. One more recent example, Akamai, not a household name, but they handle, some people say, up to a quarter of all the web traffic and focus on the cloud. So we bought the 72.5 calls in Akamai at $1. Here's a case where we needed that 5 days, because the first few days, this thing was flat to against us. But you can see as of the 4th and 5th day, this is now higher than where it was when we got in. So it's still meeting the criteria 5 days in to be positive above where we got our initial entry signal on the stock, not on the option, on the stock. At this point, the option hasn't done much. It's gone down against us at first, then it's come back up. It's stable, but it's still probably a slight loss at that point. But this rocket ship a couple days after, where Akamai got news that there was a big activist type of investor was coming in, adding board seats, looking to enhance shareholder value, the stock went from 70 to 75 basically that one day to get us all of our profits in one session there. That was a lot of fun. Actually, here's the intraday chart to show you exactly how it worked. The intraday chart's kind of interesting to me because, look, you see we were kind of flatlining for a little bit. Starts to perk up a little bit. But look at where it really launched as it got that news. You can see where we're cashing it in. But do you notice a pattern here? This is from Thinkorswim, so the other charts have been shown are from TradeStation. So you can do this on a lot of platforms. ADX trending on an intraday chart, %R, overbought and staying overbought. CCI broken out and telling you that that window of opportunity is just getting launched for that next big uptrend. So the principles work across multiple time frames here. Again, if you came in late, 13 out of 17 months profitable, but you can see 2 of those 4 unprofitable months were tiny. April was just $15 down, so kind of winners and losers balance each other out. But essentially saying, you know what, these examples are before commission, so you are going to have a little bit of loss with the commission on a relatively flat month like that. But that's okay, because look at how many times you've had big months, not just the first half of last year, but the insane gains in January, another $1,000 in February, $921 in May is about another 9% on a $10,000 portfolio gross. And even if you take your commissions out on 5 trades, you shouldn't give back much of that at all. Think of what your round trip cost would be for a 10 lot, and that's going to be what you would typically price your commissions at to take that 28,000 down a bit, but still have a heck of a lot of money left over because of how simple this is. Now, usually, because this strategy's been so popular, and we basically are down to a fairly small number of spots before I'm going to probably close the service, because I want to make sure we don't have any problems moving our folks in and out of trades, and we haven't, but I'm always sensitive to that because it's been such a popular service with that kind of performance. Usually I'd say you get a 3-month or a 12-month access. This is like my best longer-term special, but because Steve's been so good to me, I'm actually giving you an even lower risk way that you can get in and participate in this Grand Slam option service. And so what I want to show you is, let me actually show you this month-to-month offer that you can do real quick, and it's just a phenomenal value, and we'll answer a couple questions while we're looking at it here. Get a picture of my daughter there as well. But bottom line is that let's just show you real quick here our Grand Slam options page. 1 second, bear with me. It's late. My mouse is not cooperating. Here we go. Okay, let's share this with you here. But bottom line is, what we're looking at here is when you go to this page, bigtrends.com/GSO, we've got a cool little video, about 14-minute video, that kind of walks you through the service as well. If you came in late, need a little bit of a primer on how Grand Slam options works, check it out. But this is usually $99 a month, and you see with those kind of gains we've been able to generate, people have gladly paid it. But I'm doing something special, since for Candlestick Forum folks, and Steve's been so good to me, and he and I are big believers in the power of educating you and kind of getting you started, so that you can kind of be comfortable. I'm going to give you the ability to try it for a month for just $199. It's half off the normal $399 rate, but you have to use this coupon code. And if you like it, I'm going to allow you to keep it at just $199 a month. That's actually not much more by the end of 12 months than what people pay for a full year of the service on my best pricing. So the bottom line is that this is a great way to kind of keep your risk down, make sure you like it, make sure you start to understand what I'm doing. Let me show you what you need to do. Of course, it spells out all kinds of winning trades we had, including the MasterCard doubler this past month in the first half, and then also the Baidu 100, 200, and then 300% all profit targets achieved on those Baidu June 290 calls back earlier in May. So you get this access. Oh, by the way, you also get access to my Grand Slam strategy session, so I help you learn all the settings. You can set up your computer and chart platform to follow along at home, and basically make sure that if you ever have a question, we give you unlimited email access to ask any questions you want with a dedicated email. So what you do when you hit the Add to Cart button, you're going to get a month of Grand Slam options for just $199 when you put in that code. That's GSO, the letter O in caps, and then 200 off. So GSO 200. So what you do here, when you go in, initially it's going to show you it's $399. There's no shipping charge, of course, and there's no taxes unless you're in the state of Kentucky, which most people aren't. So basically all we do is we just type in GSO 200, and then we hit the apply button here. When you apply that, it should take your 200 off and then show you that you have bought the next 30 days of Grand Slam options for just $199. In a month, you should expect to see, like I said, an average of 6 to 8 trades. Last month we had 5 and still made $900, for the month of May. Bottom line is that, we're confident that you're going to see a great return on that $199 you invest for the next 30 days, and you're going to want to keep it going. And believe me, I actually like that kind of pressure because I do well to kind of know, hey, I want to make sure my monthly subscribers are seeing value, my quarterly subscribers see value, my annual subscribers see value, etc. So all you do is and you're getting a great price with this, especially for how good it's been. I can't promise that every month's going to be as good as some of the months I've shown you looking backwards. There's going to be winners and losers, but what I want to tell you is we're always dedicated to saying if the market environment's kind of choppy, you'll see us be a little tighter on our frequency, and then when the market environment starts trending, you'll see us really start pouring out the trades. We could hold up to 5 trades open at any one time if we're really in a really strong trend environment. So keep that in mind too, so you keep some capital powder dry to put to work across multiple opportunities when appropriate. So once you got that coupon in there, GSO 200, all you do is hit the green checkout button, and it'll take you down. You're on a secure one shopping cart page here that basically processes the order. We don't store any credit card information here at Big Trends. Bottom line is that you can see that we get your key information there in bold in. That's just going to allow your credit card to process. We want you to confirm your email, so we make sure you get your email. It's one way we get you the trades out. And I'm going to show you the other way in a minute, how you can get them through your smartphone as well. Take all the major credit cards here, and then you can, if Chris has helped you through the communication in the chat box, give him credit. Appreciate him taking time out of his evening from his family to help share and answer questions. And then what I want to show you here is that if you want to get the text alerts to your smartphone, make sure you have unlimited texting on your smartphone. So we do plenty of updates to tell you we're raising our stop, we're getting in this, we're getting out of this, that kind of stuff. So you'll get text alerts regularly to your smartphone telling you what to do with existing positions and new positions. And so you can say text alerts to whatever your number is, so type in your 10-digit number. And we do ask that you tell us if you use AT&T, type that in. If you use Verizon, type that in. If you use Sprint, T-Mobile, type that in. So whatever you use, type it in, and then that way we put them on individual batch lists so that nothing ever gets hung up. Everything when we hit the send button goes out at the same time. Down below, we do spell out our terms and conditions, which are in full at this first link here, so I encourage you to go copy that, paste it into a browser. But we do also tell you how automated renewal programs work, because if you like it, you don't have to lift a finger, and after 30 days, it'll renew again for another month for another $199. Like I said, I'm confident you're going to be real happy with that, investment and that recurring renewal, assuming that you're seeing the value out of the service that we've been able to generate for our folks in the past, or anything close to it, and you're going to be thrilled, I know. But if you're not, if it's not for you, it spells out for you what you need to do to let us know that you don't want to be billed in the future. So that's all very well spelled out there. Once you've reviewed all that stuff, go in there, click on the terms and conditions box, and then say, okay, look, you're saving 50% off the usual monthly rate. $3.99 is now $1.99, and I'm giving you the ability to auto-renew at that rate, so I'm not going to raise it on you. It'll stay at $1.99 every 30 days if you're satisfied with the kind of value we provide you in both quality of trades and also in the educational piece of me training you how to do this. You can actually start applying this in your own trades as well. So then you hit the submit order button, you'll get a confirmation that it's gone through, or if you have any problems, you can always go back to that order page and you can call us at our toll-free 800 Big Trends number, which is at the top right of that order page. So basically in the email is clientcare@bigtrends.com. Let me go back. We do send email CB as well as text, so you can get both. So it's just it's a kind of texting is probably the fastest way, but emails are also very good. And so we've had a lot of happy people across both of those delivery mechanisms over time. I'm sure Chris has gotten a lot of the questions here. Thanks for the kind words about my daughter. Appreciate it. She's a sweetheart. What's the win-loss ratio on the trading, says Bill D. We're typically, expecting that we're not going to win on half the trades when we buy options like this. And I don't care if I have a 40% win rate, and actually my win rate's been a lot higher than it should be because we've been that good. But I always tell people, just because we've been that good, don't play that we're going to be that good in the future. If we've been running at a higher than 50 win rate and now we're at a 40 win rate, you can see you can still make a lot of money. Why? Because like we told you, you're turning $400 into $1,100 plus on a max 100, 200, and 300% profit targets achieved. And so when you can do that, you're winning almost 3 times what you could lose at your maximum risk. And every trade that we lose on is not 100% loss. We rarely get in that position, but we might have a 40% loss, a 50% loss, a 20% loss thrown in. Those kind of losses that can happen. But when you have if you lose 20, you lose 40, you lose 50, and then you make 300 or call it 200, you're still ahead of the game. That would only be a 25% win rate. So the thought here is that you have to realize that it's about letting those trades play out over time and staying evenly invested, so that we don't tend to recommend that you load up on one and then you don't take another. We'd rather see you taking each trade on a consistent dollar amount, and that's going to give you your best experience. Just going back and seeing what else I missed. Deltas are typically, in the 30% or less areas Chris mentioned, so that's important because we don't want to. If you buy options and pay too much, there's no way you can make a 4-bagger. There's no way you can hit a home run. You'd have to be really, really lucky. Kay asked about the differences in the stock charts and the option charts, and a big part of that, Kay, is we're driving this off of the stock first, but then I use the option chart to validate that for the time and the volatility we're paying for, that the option chart is also moving. Sometimes when you see a breakout in Amazon, let's say, well, the options are so expensive that the options chart looks terrible. It's got to be really an exceptional trend in some of those higher volatility names to give you the bang for your buck if you buy an option. So that's what we're after. If you're buying an option, you should be looking at the option chart too, because that's the vehicle that you're going to get rewarded from or not. Okay, so that's really, really important to us in this approach. It looks like I'm basically going over my hour, so I don't want to basically overstay my welcome. If you have other questions, definitely shoot us an email through clientcare@bigtrends.com or drop us a call at our 800 Big Trends toll-free number. That's 800-244-8736. You don't have. Most people are putting in more than $400 a trade, so obviously as they've seen it work, they're putting in more and more. That's why we're moving so many contracts, which is why I'm always making sure that we don't have too many people in the service at any one time. Frenchie, you're so kind. The baby pick was the bonus. So sweet. But bottom line is that, you don't have to have a specific trade platform like Chris mentions there, Brad. You just have to basically be able to follow along, that you can place the trades and get in and out when you need to. Now, if that's a problem, and I'm glad we're still talking. I'm still talking here because I want to mention this too. if it's a problem for you to get in and out of these trades, because sometimes we're going to send them intraday. A lot of times we try to send them the new trade before the market opens, so you got some time to react. Sometimes we see something that's happening in the first hour and we want to be a part of it. Then if you're afraid you're going to miss something during the trading day, you can have this Grand Slam, your portfolio auto-traded through select brokers who can get you in and out automatically. If you want more information on that, just call us at our 800 Big Trends line. Chris can get you more details about how auto-trading works. You don't pay more for that. It should be the same cost as what you pay if you use those brokers' websites, but they're just helping you to basically auto-execute in, and when we say to get out, for better or for worse, for winners and for losers. We never leave you hanging at Big Trends. If it's not working, we don't try to cover it up. We just say, hey, this much time's gone by, it didn't work out, we got to say bye-bye, take the whatever loss, and move on. Versus when it's working, obviously we'll tell you how to book those as well. And we get filled most all the time, as Chris mentioned. Very rarely we don't get filled, because these are very liquid situations here. All right, so I want to say thanks to Steve and all of his team. They always do a great job hosting these events, and it's a pleasure to be with you. I hope to be with you again soon. I'll look forward to Steve being with our Big Trends community as well. But bottom line is that if you have any questions on this very special offer, half off a 1-month rate, I just don't put it out there to any group because, as I told Steve before we even got started, I've worked at this for 30 years to basically come up with this kind of a methodology that's this kind of powerful. And that doesn't mean that there won't be losses. There's going to be. I keep reiterating that because I don't want you to go in so bright-eyed and bushy-tailed that you basically forget about sensible capital management. Take a steady, small allocation to each trade and start seeing how it can do for you and not getting too high or too low, and then focus from there. CBS about what my Big Trends bands, as I call them, are. That's focused around a visual way to see when it's trending versus range-bound, tied in with the percent R methodology from Larry Williams. But it really helps me to visualize it with Big Trends bands, and that's part of what has to be in place to tell you that stock can really go up or really tank to the downside. So, and we'll help you learn the method, Bill. That's right. So you're not just buying trades. This is not a black box system. This is basically me showing you how I do it every week. I do a weekly video so you see, here's the settings, here's what I'm seeing on each of these charts, here's why we bought it, here's why we got out, here's what I'm seeing coming next, and here's things that you should understand about the methodology. So you'll really enjoy that continuing education piece. And Chip, this offer is only going to be good here for the next couple of days. I know the recording will go out tomorrow, I think, midday. So definitely check it out if you have any questions. We don't want you to miss out on future opportunities. So the longer you wait, sometimes the more you risk missing our next trade that could easily pay for not just a month, but many months of trades based on this kind of special pricing. So thanks again, Steve and his team. I'm going to say good night. Wish you great trading coming up and lots of Grand Slams to come with this very special offer. Go to bigtrends.com/GSO and take advantage of it now, or call us if you have any questions. We'll help you get set up. Thanks for Chris Sarah, my lead consultant. He's been with me over 6.5 years, does a fantastic job servicing our Big Trends clients and helping you get onboarded to start taking advantage of these opportunities. Keep trading well, folks. Great to be with you. Back to Steve and his team to wrap it up, and have a great night.